stop losses of retail traders, and there is no further need to collect more stop losses. As a result, after the liquidity sweep, we can confidently enter a trade. As mentioned previously, the primary objective of smart money is to clear out all the stop losses of retail traders. Therefore, we should enter the market after stop losses have been swept. Now let's see an example. Here we have an uptrend that price has formed bullish break of structures. Within this context, we can identify these two potential demand areas where the price could potentially reverse and continue its bullish trend. However, the key question is, how can we determine which of these zones is safer to trade and more likely to be respected by price? As we discussed earlier, we only consider a zone as valid for trading if a liquidity sweep pattern has occurred below or above it. In this case, I will not consider this decisional order block as my point of interest because the price did not sweep any liquidity before reaching it. Instead, I view it as an inducement area that provides a liquidity pool below it in the market. Furthermore, there is a substantial liquidity pool that is formed below the equal lows and inducement demand zone, suggesting the presence of pending orders and stop losses waiting to be triggered and swept by the market. By focusing on zones with liquidity sweep patterns, we can increase the probability of trading setups that align with market dynamics and reduce the risk of falling into false signals or traps. The presence of the liquidity pool above our identified demand zone provides additional confirmation for a potential price reversal from our point of interest. Now that we have the desired confluence, our next step is to patiently wait for price to sweep the liquidity below the equal lows and inducement area. Once price enters our extreme order block zone, we can consider entering a trade. Now let's move on to the triple bottom.